Hi, everyone. This is Joe Gentili from Sarraf Gentile LLP. So there are a lot of myths and a lot of misstatements, in my opinion, floating around with regards to IULs or index universal life insurance on social media and online. One of the most common misstatements I see, and I think it's probably the most damaging one, is that you can't lose money by investing and putting money inside an IUL. And the reasoning goes that you put the money inside the IUL takes the money you save in it and then hinges it to an index. And that index comes with a floor. So no matter how bad the index does, you can never get less than a zero return on the index. So if your index is hinged to the S&P 500 and the S&P 500 has a horrible year and loses 30%, you're still going to get a zero floor. That is true. Index universal life insurance policies do have crediting floors. The part of that story that's left out and makes it misleading is that index universal life insurance has fees attached to it and charges that are attached to the policy every year. There's a commission that's paid to the salesperson, and there's a commission that's paid to the marketing organization. There are administrative fees in the policy, and then long-term, the most significant charge that is within the policy is the cost of insurance. It is a life insurance policy after all, and you do have to pay for the life insurance. So the way life insurance works is that for universal life insurance, which is basically like getting term insurance for life that's repriced every year, is that it's cheap to insure somebody that's young. So when you first get that policy and you're young, the cost of insurance is low and it's not taking out a huge amount of money, but it's expensive to insure older people. So as you age, and particularly after you get past retirement age and you start to get into the ages that are kind of normal life expectancies, the cost of insurance inside these policies is very expensive. It's also subject to raises by carriers if their expectations aren't what they thought they would be. So if people are living shorter lives, the carrier is making less money on the policies than they thought, they could raise the cost of insurance even further. So you always, when you have a universal life insurance policy, you always have to try to outrun that cost of insurance. You have to be gaining money in that policy faster than the cost of insurance goes up. So you got to build up a reserve when you're young to offset the higher costs when you're older. Now, on an index universal life insurance policy, you're going to be given something called a target premium, which is the amount that they say that you should fund the policy, and they'll have an assumed rate of return for that target premium, like 6.5%. Let's say that's a common assumption. That means that for the policy to perform as it's illustrated, you have to be paying the premium every year. That's a target premium, and the policy has to be earning 6.5% a year. Frequently, policies earn less than the assumed amount. If not sporadically, they may even average less. So let's say over time, your policy averages a 4% return instead of a 6.5% return. So you may not notice that as a big problem in the beginning because the cost of insurance is low. So you're seeing your cash value still increase. What you're not seeing is they're not increasing fast enough to offset this cost of insurance that's coming on later down the line. So it's a common scenario where somebody buys an index or universal life insurance policy, it could be indexed. The person that sold the policy is not servicing it long term for whatever reason. They're long gone. So the person that bought the policy just funds it every year. They pay the premium every year that they're supposed to be paying. And then a couple of decades later, they wake up and they see that there's not nearly as much cash value as should have been there. Maybe the cash value is pretty close to zero, and they're going to have to kick in a lot more premium to keep the policy in force. So what happens is the policy ends up lapsing because the cost to keep that policy in force every year as you get older just gets progressively more and more expensive, and it eventually becomes unaffordable because it hits you at the worst possible time, and that's after you've retired and you're no longer working. So in that scenario, not only is it possible to lose money in an IUL, you're not just making less money than you thought. You could very easily end up with a zero. Because if the cost of insurance outpaces the returns and what you're putting into the policy, you could end up lapsing the policy because the cash value will go to zero. Because while you can't get a negative crediting for the index performing poorly, you will get your cash value reduced by the cost of insurance eating into it. It could get even worse. If you unfortunately had policy loans, if you borrowed money out of the policy over the years, the policy had a gain at some point. If you lapse the policy with policy loans outstanding, you could get a tax bill for the forgiven loans or the gains on the forgiven loans. So it is very possible that you could lose money on an IUL. So anybody that's telling you that this is a way to invest or save money with no possibility of loss, it's just not true. So if you've bought an IUL and you feel like you bought it under false pretenses, if you feel that the marketing was misleading, it's not what you thought it was going to be, my law firm, we're happy to review the policy to see if there's any potential legal claims with it, because sometimes there can be. So we're happy to do that. We don't charge to do that. If you have any questions, feel free to reach out to us. And if this is a topic that you're interested in, if you're interested in the intersection of law and life insurance and annuities, I encourage you to subscribe. Thanks. Have a great day.